Your money-making broadcast starts now. Markets closed this evening with a sharp divergence for Canadian investors. The TSX took a hit as crude oil cratered nearly 7% after news broke that the Strait of Hormuz is partially reopening, sending shockwaves through Canada's energy-heavy index. But the pain in oil was offset by a massive semiconductor rally that lifted TSX-listed tech names, giving the broader market a split personality. Meanwhile, all eyes were on Edmonton-born Greg Abel, who just delivered his first annual meeting as Berkshire Hathaway CEO, earning solid reviews even as Berkshire shares struggled. Silver surged 6.8%, gold miners rallied, and the AI trade continued to reshape market leadership. Let's break down exactly what happened and what it means for your portfolio from a Canadian perspective. Let's start with the story that has the biggest implications for Canadian portfolios, the oil crash. West Texas Intermediate crude fell 6.8% today after reports confirmed a partial reopening of the Strait of Hormuz, the critical choke point through which about 20% of the world's oil passes. This is a direct body blow to the TSX, which carries a heavy energy weighting. Canadian energy stocks including Suncor, Canadian Natural Resources, and Tourmaline all came under pressure in sympathy with the broader sell-off. The Energy Select Sector SPDR Fund, the XLE, dropped 4.1%, while ExxonMobil fell 4% and Chevron lost 3.9%. Occidental Petroleum, which is Berkshire Hathaway's largest equity holding, plunged 7.2%. This sets up a fascinating dynamic because the UAE's exit from OPEC has already injected uncertainty into the global oil supply picture, and now a geopolitical risk premium is being stripped out of prices as the Hormuz situation de-escalates. For Canadian investors, this means one thing: the energy trade that has worked so well this year is suddenly under pressure, and that demands a re-evaluation of your portfolio exposure. Now, let's bring in the legendary fund manager who said by what you know, Peter Lynch. He would look at the oil crash and ask a very practical question: do you understand the businesses you own in the energy space? If you own Enbridge or TC Energy, you own pipeline infrastructure that collects tolls regardless of where crude prices go. If you own a pure upstream producer like Canadian Natural Resources, your earnings are directly tied to every dollar move in oil. He would argue that the Canadian investor who bought what they knew, who understood that pipelines are toll roads and producers are commodity plays, would have positioned accordingly. He would not panic out of quality infrastructure names on a 7% oil drop. He would instead use the sell-off to add to positions where the underlying business fundamentals have not changed. The Strait of Hormuz reopening does not change the fact that Canadian oil production is at record levels, and that the pipeline network is running at full capacity. That is the kind of durable everyday insight that separates disciplined investors from the crowd. Moving to the biggest winner of the day, Advanced Micro Devices surged 18.6%, leading a semiconductor rally that pushed Intel up 13.2% and Qualcomm up 8.1%. This AI-driven semiconductor boom is a direct tailwind for TSX technology names, and none more so than Shopify. While Shop itself was not the story today, the broader semi-rally creates a rising tide that lifts all Canadian tech boats. The growth stock pioneer, Phil Fisher, would take a careful approach here. Fisher was famous for studying the competitive advantages that allow great companies to compound capital over decades. He would look at Intel's foundry turnaround and ask whether it has a sustainable moat. He would look at AMD's data center pipeline and assess whether its architecture lead is durable. But Fisher would also look at Shopify and recognize a company that has built an unparalleled ecosystem of merchants, developers, and AI-powered tools. Fisher's scuttlebutt method, which involves talking to customers, suppliers, and competitors, would reveal that Shopify's merchant retention rates are best in class, and that its AI tools are deepening the competitive moat, not weakening it. For Fisher, a company with a genuine competitive advantage trading in a favorable macro environment is exactly the kind of opportunity worth holding through short-term noise. Let's turn to a story that hits particularly close to home for Canadian investors: Greg Abel's first Berkshire Hathaway annual meeting. Abel, who grew up in Edmonton and built his career at Berkshire's energy and utility operations before being named Warren Buffett's successor, earned a solid scorecard from analysts and shareholders who attended the Omaha event. But despite the positive reception, Berkshire shares struggled, reflecting broader market concerns about the conglomerate's massive exposure to Occidental Petroleum, which fell 7.2% today, and its insurance operations, which face headwinds from a softening premium cycle. The master of contrarian investing, John Templeton, would see the Berkshire story and immediately recognize a classic buying opportunity. Templeton famously said that the best time to buy is when there is blood in the streets, even if the blood is your own. Here you have a Canadian CEO at the helm of the world's most respected conglomerate, a business with a fortress balance sheet, and the stock is struggling because of two temporary headwinds: oil price volatility and insurance cycle dynamics. He would argue that those are precisely the conditions under which patient contrarians should be adding exposure, not reducing it. Greg Abel is a known quantity to Canadian investors, and his disciplined capital allocation approach mirrors the very principles that made Berkshire great. The oil crash also has a silver lining, and it is literally silver. Silver surged 6.8% today as the gold versus oil trade divergence widened dramatically. Newmont Mining, a TSX heavy gold producer, gained 5.6%, while Freeport-McMoRan, the copper giant with significant Canadian operations, rallied 5.6% as well. This is the classic commodity rotation. When oil crashes on geopolitics, capital rotates into precious metals as a hedge against the uncertainty that caused the oil move in the first place. The father of value investing, Benjamin Graham, would approach this divergence with his trademark discipline. Graham would look at Freeport-McMoRan and Newmont and ask, what is the intrinsic value of these businesses relative to their current market price? Copper demand is being structurally boosted by AI data center construction and the global electrification trend. Gold is benefiting from central bank buying and rising geopolitical uncertainty. He would calculate a margin of safety in the miners that you simply do not find in the broad market today. At current valuations, Freeport-McMoRan trades at a reasonable multiple to forward earnings, with copper prices supported by supply constraints and demand growth from the AI infrastructure build-out. That is the definition of value with a safety margin. Let me touch on a few other movers that matter for Canadian investors. Walt Disney surged 7.5%, General Electric gained 6.7%, and the broader market showed remarkable resilience outside of the energy sector. The ADP employment report came in at a 15-month high, confirming that the labor market remains strong despite the crosscurrents in commodities and geopolitics. This is good news for Canadian investors because a strong U.S. labor market directly benefits Canadian exporters and the overall North American economic outlook. The Anthropic AI venture backed by Goldman Sachs and Blackstone at $1.5 billion in institutional capital confirms that the artificial intelligence investment cycle is still in its early innings, which provides a structural tailwind for TSX-listed tech and AI-adjacent names. On the negative side, PayPal fell 8.9% despite beating earnings, Palantir dropped 6.8% despite record revenue, and Coinbase announced a 14% workforce reduction as the AI-driven layoff wave continues to reshape the tech landscape. These are the kind of company-specific shocks that create opportunities for disciplined investors who do their homework. Now let's get to the stock picks that deserve your attention after today's session. First up, Shopify, ticker SHOP, which is Canada's largest technology company and a direct beneficiary of the AI and semiconductor boom that dominated today's trading. While SHOP did not participate in the AMD-led rally directly, the semi-boom confirms that the technology spending cycle is accelerating, not slowing. Shopify's merchant platform, its AI-powered fulfillment network, and its expanding suite of financial services products give it multiple levers for growth. The semi-rally tells us that institutional capital is rotating back into tech, and Shopify is Canada's most liquid and most recognized tech name. Every Canadian investor knows this business, and the investing philosophy of buying what you know points directly to it. Second, Enbridge, ticker ENB, at roughly 42 Canadian dollars a share with a dividend yield above 6%. This is the contrarian energy play for the current environment. The oil crash today creates a buying opportunity in the best infrastructure name on the TSX. Enbridge collects tolls on Canadian energy regardless of where crude prices go, and its pipeline network is operating at record utilization. The Strait of Hormuz reopening is a near-term headwind for sentiment, but does not change the fundamental math of Canadian energy infrastructure. This is the kind of opportunity where buying into weakness, while others panic, pays off. Third, Cameco, ticker CCJ, at roughly 70 Canadian dollars a share. The nuclear uranium story is one of the most compelling Canadian growth themes for the rest of 2026. AI data center power demand is driving a structural increase in uranium contracting that benefits Cameco as the largest Western uranium producer. The same institutional capital that is pouring into semiconductor stocks via the AI theme is also recognizing that you cannot run data centers without reliable baseload power, and nuclear is the cleanest, most scalable source available. Cameco has a genuine competitive advantage in a resource that is becoming increasingly strategic. The nuclear renaissance is real, and Cameco is the purest Canadian way to play it. Fourth, Freeport-McMoRan, ticker FCX, as the mining and copper play that benefits from both the gold-silver rally and the AI infrastructure build-out that is driving copper demand. FCX rallied 5.6% today alongside Newmont, and the copper thesis is straightforward. The world needs more copper for electrification, data centers, and renewable energy infrastructure, and supply is structurally constrained. This is a business trading at a reasonable valuation with a strong balance sheet, and a commodity that is in structural deficit. The margin of safety comes from the fact that the market has not fully priced in the multi-year demand cycle for copper from AI and electrification. It is value with a growth kicker, which is exactly the kind of setup that disciplined value investors look for. To wrap up the big picture for May 6th, the oil crash is real, and it hurts the TSX in the short term, but it creates opportunities for Canadian investors who can distinguish between temporary sentiment shocks and permanent structural changes. The Strait of Hormuz reopening is a geopolitical positive that removes a risk premium, even if it hurts energy stocks in the near term. The semiconductor rally confirms that the AI investment cycle is accelerating, which benefits TSX tech names and uranium plays alike. Greg Abel's strong debut as Berkshire CEO is a point of pride for Canadian investors and a reminder that disciplined capital allocation works across any market environment. Buy what you know. Buy when others are selling. Always demand a margin of safety. Focus on competitive advantage. All four of these principles point to the same conclusion from different angles. Quality businesses, bought at reasonable prices during temporary dislocations, are the foundation of long-term investment success. Keep cash ready for opportunities like this oil-driven pullback in energy infrastructure. The market prices tomorrow's news, not today's headline. Focus on businesses you understand, industries with structural tailwinds, and positions where you have a clear margin of safety. That is the market close for Tuesday, May 6th. Oil crashed on Hormuz reopening news, but Canadian energy infrastructure remains sound. The semi-boom lifted TSX tech, and the AI trade keeps running. Greg Abel earned his stripes at his first Berkshire meeting, and that is a story Canadian investors should watch closely. Keep your focus on quality, stay disciplined, and remember, the best opportunities come when everyone else is looking the other way. I'm Chloe. Thanks for watching the Market Close recap. If this analysis was helpful, subscribe and hit the bell so you never miss a session. I will see you tomorrow at 7 a.m. Eastern for shorts, and back here tomorrow evening at 8:30 p.m. Eastern for the full Market Close breakdown. Until then, invest wisely, Canada. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.